This is Mark Anthony with Mercury Time Price Analytics. Thank you so much for checking out this video. This is our daily update for Monday, July 27th for algorithmic futures trading for S&P futures, the ES, E-mini and micro contract, as well as the NASDAQ NQ contract. If you're a chart geek, you are going to love this video. You may want to watch this twice. If you have any friends that are chart geeks, this is a video you're going to want to share with them. I'm going to try and keep these videos a little shorter. There is so much going on from a technical perspective, from an algorithmic perspective right now, and I tried to get into as much detail as possible, but a lot of these videos are running over 20 minutes, and I'm really going to try and keep them a little bit more brief. But man, do we have a whole lot to talk about tonight. We're going to come back to this chart on your screen. Got a number of screenshots prepared. So let's start with the bigger picture. Okay, so this is our long cycle oscillator, and you can see this goes back to the beginning of last week. Very, very long time cycle. The time cycles here are several hours. But what I want to point out is the support down here at this very deep retracement, this purple oscillator. We came down into it, and now we're right back into it again as of Friday afternoon. From a technical perspective, you don't like to see a deep move like that, which was Tuesday of last week, and then come down that quickly in about a week and a half down to the same level. Now, it's not down to the same level in price, but it's down. Friday, it was down to the same level in the oscillators. What was really interesting about last week is we had multiple pullbacks, down to our Algo weekly pivot for last week of 31.92, and that's just not something you want to see. You can't keep banging on these weekly pivot levels over and over again and expect them to hold. So let's take a look at a little bit zoomed in. We're going to look at this portion of that chart. Now, there's a lot going on the screen here, but what I want to point out is you've got this fast oscillator. Now, again, this is a multi-hour chart, but still, this purple algo is the fastest oscillator on here. And you just, when you crash through all these levels, to put it in perspective, there's a thing they call the death cross, and I hate that term, but what it is when the 50-day crosses through the 200-day moving average, up or down. That's when it crosses down, it's a death cross. When it crosses up, it's the opposite. It's a positive development. But the same type of concept is in play with these algorithmic oscillators, especially on a really long cycle. If we're looking at a very short, say just a few minutes cycle, you see this kind of stuff all the time, but you don't see this very often on a very long cycle. And what you notice is you didn't crash through all these levels when you came down here before. This time you have significant technical damage, and that's what makes this move down that we had last week potentially much more significant than the pullback to that purple oscillator that we had the week prior. Now, one of the cool things about our system is we've got algorithmic regression lines. We've got algorithmic oscillators. We've got fixed horizontal pivots like the daily bull bear pivot. But this is a lot to assimilate, and keep in mind that you're trading against computers. You're trading against the high frequency trading algorithms that are run by the institutions. So what we do is we automate it so that you don't have to make a lot of decisions. Yes, you have all these different metrics on your screen, but the algorithm itself is automated. And I want to show you a couple examples of that. So we're going to take a look first at NQ for last week, and also for ES to give you an idea how this works. Now, the cyan line is our proprietary momentum algo, okay? And on each price bar, you'll notice that there's two little white dashes. That's our proprietary volatility metric. Forget about the VIX. From a day trading perspective, it really isn't that important. because what's important in terms of volatility is the second derivative, and that is volatility compared to itself. Where was volatility half an hour ago, an hour ago, 2 hours ago? And that's what these little white hashes or dashes do. When they are getting closer together, volatility relative to itself is compressing. And so what happens when you get a market turn, a good opportunity to go long or to flip from long to short, two things happen in our algo. The first thing you get is a directional change in the cyan momentum algo. And that would make sense, right? If momentum is going down and then it troughs, it hits a low point and turns back up, and it's going to have legs, well, you want to be long, right? But momentum ebbs and flows throughout the day all the time. What you want to do is you want to get into the trade at the point that not only has momentum changed direction, in this case from down to up, but you want to get in on the long side at the very point that volatility is about to expand. And I'm talking about that second derivative of volatility. So here you have Monday of last week, Monday, July 20th. And you get this move down. The momentum algo turns up. The change in direction of the momentum algo simply puts the system into the ready state. It alerts you that something may be about to happen. The actual entry, long in this case, is once the little white volatility dashes that were reasonably spaced, down at the bottom, when you get the turn, they start to compress. And here they're very compressed, here they're completely merged together. And what happens with this algo, because this is the way it was designed, is the point where volatility is the most compressed is right before, the bar before the volatility dashes cross over. See here and here? They are completely compressed. The two little dashes look as one. And when it does actually print a bar where they cross over on the other side, then volatility starts to expand. Notice how each one of these dashes per bar is starting to expand. And that's what carries price upward in this case, because what you had is a change in the direction of momentum from down to up, and you had a transition in volatility of expanding volatility to contracting volatility, and then volatility expanding once again as price moves higher. Now, you don't always get these kind of crazy blow-off moves like we had last Monday, but that's what the algo does. And what's cool about this algo, additionally, is that you almost always get a second chance entry. Now, we've got, in addition to the cyan momentum algo, we have a white oscillator and a purple oscillator. The purple oscillator is slower, and you can see that it moves slower by the more gradual slope. But the back test that you get, typically all you get on a real strong move is a back test to the momentum algo, the cyan line. Here you got a back test all the way back to the white oscillator. Now, what's great about this little part right here is that the really big moves upward occur when you have a bear trap, just like the really fast moves lower happen after you have a bull trap. And here's what I mean. You had this move start down here in NQ below 10,580. It comes up here to about 100 handles. And then you get this abrupt move down, about 80 handles. Now, if your predilection at this point in time was to short the market, because look, a lot of traders have a preconception about which direction they think the market's going to go, and then they act on it. Well, the problem is you can't be stubborn short and you can't be stubborn long, because when you had this pullback, this real deep, fast pullback, I'm sure everyone was thinking, all right, this is the one that's going to go. People load up the boat on the short side. Well, guess what? Those people that got short here, they got short against the two things that'll kill you when you're short. They got short against a rapidly accelerating momentum algo, and they got short against volatility that was expanding in the other direction. And so you always get, almost always get these second chance opportunities after the signal, the algo signal was fired. So here's your long trigger. Monday the 20th, 6:51 a.m. at 10,625. Well, if you're not trading typically at 6:51 a.m., if you're on the West Coast where it's 3:51 a.m., you know, might not have been an opportunity you could have caught. But then you have this pullback at 9:33 a.m. East Coast time, 10,608. That was your second chance entry. And actually that, let's see. Yeah, that was it. It pulled back just a little bit below the entry because on the entry bar, the open of the entry bar is right here. So you actually had a little pullback below it, but momentum algo is still strongly trended up. Volatility was expanding. And if you didn't catch this first move, that was the ideal second entry. So we saw this move up. Now, the night before we had the turn, I posted on Twitter, it was literally about 15, 20 minutes before price got up into this 10,983. Price was about right in here. And I posted that this number, 10,983, was the number to watch in Globex Monday night after we had this run and in the day session Tuesday morning. And that right there, when it crossed back over, that's when the algo flipped from long to short. And you see the same thing that you had down here happen in reverse. Momentum algo changes direction from up to down, like in the shape of an inverted U. And when it gets up to the top, notice how wide the volatility dashes are on the way up. And then when it gets here, they start to get really tight. Price rolls over. Momentum line changes direction. That tells you it's in the ready state. And then right here is where you had the crossover and back down. Let's look at that same thing on ES. So here we have Monday, and this is something very interesting. And if you want an example of market manipulation, and I hate using that word because markets have always been managed, but they've never been managed to this extent. So let's use the word managed rather than manipulate. Our weekly algo pivot that we came out with on the weekend, 31.92. Now, what time does the European market open? 3 a.m. 3 a.m. Eastern Time, U.S. Right at the open of the European session, you got to move down below the weekly pivot. Well, what happened next? The bazooka came in and they took this thing straight up. You cannot, if you're managing this market, you cannot have the S&P futures breaking the weekly pivot the moment that Europe opens at the beginning of the week. And we had multiple moves back to this 31.92 later in the week. So here you have the algo that got long Monday morning. This was your second chance entry. And again, deep pullback creates a bear trap. The momentum algo is still strongly sloped upward. The volatility dashes did nothing but go sideways, even though you had this pullback. And that's what tells you it's going to be a bear trap. You had this deep pullback. Volatility dashes didn't even come anywhere close to the momentum algo. They just went sideways. So volatility was going sideways when price was going down and momentum was going up. Boom, you go back up. So let's see what happened at the top. Chart 4. So here is the opposite. Momentum algo slowly starts to roll over, and now at this point it starts trending down. And this is where you had the volatility metric crossover. And here you not only had one second chance entry, you had three. Second chance entry here, check back to the algo oscillator. Second chance entry here again, check back to the algo oscillator. Second chance entry again. And notice on all three of those times, the volatility metric did nothing but go sideways. Sideways with a price backtest. Sideways with a price backtest. Sideways with a price backtest. So you literally had 4 opportunities to short this thing. Now I'm going to show you the exact spot where we had the technical breakdown, which was at 32.62.75. I'm going to show you that in detail. Very, very cool. And again, I'm going to try and keep this video on the short side. I think this one we want to come back. Okay, we're going to come back to this. Is this the one I wanted to show you next? Okay. We've got a whole new suite of tick algorithms because ticks give you a truer read on what's happening internally in the market than price. The institutional algos can mask a lot of things in price, but ticks are ticks, and yes, you can manipulate ticks too. But if you know what to look at in ticks, it's hard to fool a professional technician with ticks the way anybody, no matter what your experience level is, can be fooled just by looking at price action. So here we have our tick metric. The purple oscillator is the fast tick oscillator. And you can see you had this peak. And what we look for on these tick oscillators is we look at crossovers where the faster oscillators cross over the slower ones. So this purple oscillator is the fastest one. Then going up as they slowly get longer cycle, which means slower turn, more gradual slope, you have the dashed white one, and the next longest is the solid white one. And then you get into these trend algos. The fastest of the orange trend ones is this one, and then a much slower, more gradual one is down here. So here you had the crossover. And that right there told you that there was a problem. That was, give or take, about 8 a.m. on Thursday. Now, the second indication that there was something wrong with the tick is we had this very severe angle of attack with this crossover. It's pretty violent, the angle at which the purple algo comes down through the dash white. So it hits the bottom, comes back up, rolls over, and cannot get back up above the white algo that it just had violently crossed through. And it is just barely above the third algo, this solid white one. Rolls over, comes up again, rolls over. Now this was the bull trap right here. Now this time you had the purple algo come up above both of the white ones and then roll over. Now you want to see something really cool? The oscillators are a second derivative of the tick. The slope of the oscillators relative to themselves, meaning the slope of purple relative to purple, is the third derivative. So right here where we had the purple oscillator crest, right here, the peak of it, notice where this one came up to? Not quite as high, and it rolled over. And you see that on all of these. Here you have this little crest right here. White one rolls over again, but the key right here is you have this movement up here. It doesn't get above this little crest here, and then it rolls over again. So there's your bull trap. All of these systems are designed to harvest energy, so to speak, from a bull trap and a bear trap. Just like we saw before, you had multiple second chance opportunities to get short here and here, and then you get the fast move down. Now, again, I want you to remember this price level here at 62-ish. Not only did you break one of our algo regression lines, but I'm going to show you precisely what happened right here. Now, this is the second piece of the tick chart that we just looked at. Here's the high and the turn, and let's talk about what happened after that. So here's the second piece of that chart. Notice all the failed retests. Failed retest, failed retest, failed retest. Here. I mean, it's just over and over and over again. And look at how many times you came down to test that weekly pivot. Got close here, had a direct hit here. And, you know, that was the one that they had to save And as I told our subscribers, this was likely not to be broken because they weren't going to let the weekly pivot get broken in the afternoon on Friday. That rarely happens. Most professional traders have finished doing their business by the lunch window on Friday. There wasn't enough volume because of the low volume on Friday. It didn't take a lot of horsepower, a lot of juice to keep this thing from breaking. But you see that big turn at the top, and then it's backtest failure after backtest failure over and over and over and over again. Now, let's show you what happened today. And oops, email is not what I intended to go into. All right, so here we go. Our algo regression lines. Now, these algo regression lines, and we're going to wrap this up in just a couple minutes. Our algo regression lines are not the same type of regression line that you'll find in your, any canned trading platform or chart package. I don't know what the math is they use, but it's garbage. The reason and please hear me on this, the reason our algorithmic regression lines are the most accurate commercially available is simply because our regression line algo uses the same algorithmic cycles that the institutional high frequency trading algos used. It is the same. If you work for one of those companies and you're watching this video, you know exactly what I'm talking about because this is exactly what y'all programmed. Same thing. So the regression lines. Now, the regression lines are a function of time and price. And of the two, time is much more important than price. Time at its essence is a vibration. If you've read or studied any of W.D. Gann's work, you know what Gann is talking about. Time is more important than price. Now, what happens at these regression lines, they're very binary. Price will either come up to the regression lines and dramatically fail, or it'll fight over it for a time and then release. And same thing when it comes down into them. Either you get a violent break through the regression line like you had here, or it'll come up and fight over it back and forth and then release. But here's the big deal right here, 32, 62, 75. Because we are constantly pushing the envelope in our algorithms looking at, okay, what's the third derivative, the fourth derivative? Well, the regression lines are literally a third derivative of time and price. Well, there's always an additional derivative. And this is what we call a regression line vector. So we take our proprietary Mercury algorithm regression lines, and the point at which two regression lines intersect, you take a horizontal line going forward, that's the vector price. Well, this cross right here, the vector, is exactly 32, 62, 75. What happened when that broke? It broke, it came up, it was rejected, they recovered it, down again, you came up, and then this time when it broke in earnest, that was it. Now, as if right on cue, what's happening right now in the S&P is you're coming up to another vector right here. I put this out for our members tonight. This is the spot you want to watch, 40.50. I posted it on Twitter. We are exactly at 40.50. Now, whether this goes through or not, I don't know. But if this is the high, I called it before the Globex session opened tonight. This couldn't be any better. This is happening live as I record this video, and this was precisely the point of this entire video. That if price comes up and is rejected, and I don't mean rejected at this moment, price can come over it, fight over it up and down, but ultimately, if this level is lost, like this vector was lost, then this can end up being a very, very interesting week. So keep in mind this level right here, 32, 40, 50. Perfect way to end our video tonight. We thank you so much for your time. We hope you'll come back again. If you're a chart geek, if you're a trader, if you're an algorithmic person, Share this video with one of your friends. Like it on YouTube. Feel free to repost it on the internet. This is one video that every trader needs to see. God bless you. God bless your family. And we hope to see you again soon.